Today, we're going to talk about the back-to-break setup, and together we'll refine and optimize a practical trading strategy built around this setup. This is not just a simple entry. This strategy has a few key parts. First, the entry scenario. Second, the exit scenario. And most importantly, staying disciplined with a simple checklist that helps you avoid emotional trading. If you follow these three things correctly, this setup can give you really solid trading opportunities and help you catch cleaner, more logical moves in the market. But before we get into the entry rules, there's one very important thing. If you haven't watched the previous video yet and you're not familiar with higher highs and lower lows, make sure to watch that video first. The link is on the screen right now, and I've also put it in the description. After watching it, come back to this video, because here I'll show you step by step how to enter trades using this exact setup, so you can apply it in your own trading with clarity and confidence. Now, let's go back and take a closer look at the bullish higher high schematic. In this section, we're going to walk through step by step how to use this structure as a clear, practical trading strategy. The first thing we need to confirm is that the bullish breakout is fully validated. As you can see, we have a strong candle close above the breakout level, a level where price failed to form a lower low compared to the previous one. This confirms all the key characteristics of a valid higher high, meaning the market structure break is complete. Next, we simply wait for price to pull back into the broken level, the same area that previously acted as resistance and is now expected to function as support. Within this zone, we look for our first confirmation based on our strategy checklist. After that, we wait for the second confirmation, which is a candle confirmation. Make sure to watch the video placed in the corner of the screen so you clearly understand what type of candle we're looking for in this area and what exactly qualifies as a valid entry signal. Finally, once the candle confirmation is in place, the strategy is complete, and we execute the trade with a 1-to-2 risk-to-reward ratio, fully structured, patient, and strictly according to the plan. See how this strategy actually plays out on the downside. As you can see on the chart, a clear lower low structure has formed, which tells us that the market is showing bearish continuation. Based on that, our main scenario is focused on short trades. But the key point here is that we don't enter trades blindly. Our first confirmation is a pullback to the break. After that, we wait for a valid candlestick confirmation in that area. That's where the entry starts to make sense and the risk becomes much more controlled. Later in this training, we're going to break down more advanced scenarios and strategies based on this same setup, so you'll know exactly where to enter, where to exit, and how to make more professional trading decisions. In this bearish leg, we want to analyze the areas where we can look for trade entries and how we should make our decisions. The first and most important step is identifying the downtrend because we always want to trade in the direction of the market. Here, the formation of lower lows and the continuous break of previous lows confirm that the market is in a bearish trend. In the first trade, we see one of the best setups in this strategy. We get a clean pullback into the broken area, followed by a very clear and strong candlestick confirmation. This is exactly where an ideal entry is formed. However, in the next pullback, we experience a stop loss. The key point here is that structurally, everything looks correct. We have the break, the pullback, and even the candlestick confirmation, but the market still takes our stop. This is a natural part of trading and something every trader must accept. After this stop out, the market provides us with another trading opportunity. This time, the candlestick confirmation is not as clean as the first trade, and this is exactly where your backtesting experience and trading skill come into play. We can see a strong, engulfing candle forming. Instead of entering aggressively, we wait for confirmation of this candle. On the lower time frame, after the next two candles form a lower low, we receive the proper candlestick confirmation and execute our entry with more confidence. In the fourth entry, once again, we have a pullback to the broken level, but this time the candlestick confirmation appears with some delay. Interestingly, this delayed confirmation aligns with the formation of lower lows on the lower time frame, which not only validates our entry, but also creates opportunities for additional trades. Here, we're going to walk through a different entry model within the back-to-break setup, a model that's specifically designed to address one of the most common psychological challenges traders face. In the first scenario, we only entered a trade after receiving full candle confirmation. This approach is highly accurate, but it comes with an important drawback. There are some times when the market doesn't wait for candle confirmation and moves exactly in the direction we were expecting. As a result, simply because we didn't get that confirmation, we miss the move. And over time, this creates psychological pressure and frustration. This is where Scenario 2 comes into play. In the model you see here, we are no longer dependent on candle confirmation. However, this does not mean emotional or rule-based entries. On the contrary, this approach helps create a proper balance between trading logic and trader psychology, so we're less likely to miss important market moves. In this scenario, instead of candle confirmation, our checklist includes a different condition: 2 consecutive breaks occurring in a fractal structure. The entry and exit scenario in this strategy is defined as follows. After the market breaks a level, when it returns back to the breakout zone, we start looking for entry opportunities. This zone begins from the first breakout reaction and extends to the second breakout, and within this area, we can consider entering a trade. In terms of risk management, we have defined 2 different stop-loss models. Each of these stop-loss options comes with a different win rate and risk-to-reward ratio, and choosing between them completely depends on an individual's psychological tolerance, trading personality, and risk appetite. The best way to select the most suitable stop-loss is to backtest this strategy and evaluate which model aligns better with your mindset and trading style. Now let's look at the same model in a bearish structure and see how it actually forms. Just like in the bullish model, our main focus here is on consecutive breaks that happen in a fractal manner. After each break, price comes back to the previously broken area, and that's where the setup is formed. In fact, the logic behind the back-to-break model in a bearish structure is exactly the same as in a bullish one. The only difference is the direction of the market. When it comes to stop-loss placement, it's also the same idea. There is no fixed stop-loss. We have multiple options. Which stop-loss works best for you completely depends on your trading personality. That's why I strongly recommend backtesting this model and choosing one of the stop-loss options you see on the chart, the one that best fits both your risk tolerance and your psychology. Let's go through a real example of this trading model together. In the first trade, all the conditions are perfectly aligned. We have a consecutive market structure break in a fractal form, followed by a pullback into the broken area, which creates a very clean and valid entry opportunity. However, the second trade includes a very important and key detail that we must pay close attention to. In this case, the breaks happen consecutively, but the second break takes out the high of the first one. In this situation, we have an important rule. The pullback after the second break must be smaller than the pullback of the first break in order to consider a valid entry. If the second break takes the high of the first one and then produces a pullback that is equal to or larger than the first drop, this setup becomes less reliable and will naturally result in a lower win rate. So always pay close attention to the size of the pullbacks, because these small details are what separate a professional trader from an average one. If you found this explanation helpful, make sure to like the video, share your thoughts in the comments, and subscribe to the channel for more educational content.